The biggest mistake investors make to start every year is thinking they have to make a big move, just like resetting a clock. Most of the time, the smartest move is making sure that you're not doing too much.
All right. Hey, Tony, how we doing?
Good, man. Happy New Year.
Yeah, same to you.
Yeah, it's a lot of action in the beginning of this year.
Oh, yeah.
As we're recording this, there's it's going out stealing presidents and bringing them back to the United States. I don't know, man. There's some crazy stuff going out there.
Oh, yeah. Jim Harbaugh fired.
Yeah, you want to talk about football? You want to talk about politics? Holy bananas.
Yep.
So
lots of action in Venezuela. That's for sure.
Yeah, that too, man. So what we're going to talk about today are, some of the biggest mistakes that investors make early in the year. So we're going to talk about some of these mistakes, and maybe they're not quite mistakes, but you don't have to go in on January 1st and say, all right, what's the investment theme this year?
Right.
I mean, it can be, but you don't just flip the switch, or reset the clock, or, slam the door shut on what's happening last year, because, it takes a long time for sometimes the metric ideas to play out, or investment ideas, right?
Yep, for sure.
All right, so one of the first mistakes is overreacting too early to market moves. So, I would say, just like any year, going into the back part of every year. So like through Christmas time, the holidays, there's not too much going on. And that played out again this year.
Right.
Just people on vacation, there's not too much turmoil and things like that. But as soon as, the first day of the market, oh my God, it's 2026, and last year's strategy worked pretty well. How can we change it? Because something new is going to happen, right? So just making sure that if you are going to change your positioning and the route you want to go, it doesn't need to be a drastic move.
Yep.
So that's kind of how I'll set the stage. What are your thoughts, D?
Yeah, absolutely. It's if you don't have a plan in place, you don't have an investment strategy, you're just kind of flying by the seat of your pants all the time, then maybe at the beginning of the year is a good time to kind of take inventory, get things in line. But if you already have a plan in place and you've been executing it, maybe you're in retirement or approaching retirement, and you have a strategy together. Just because the calendar flips over doesn't mean you need to make these big, bold, drastic changes.
Yeah, I think the thing that every investor should do is, why don't you just start with being well balanced?
Yes.
And then maybe you can start looking around and saying, hey, I think megatech is going to outperform financials this year. Well, I'm just picking something, I'm not saying that that's happening, but okay, if you had 10% in financials and you got 15% in large mega tech, okay, why don't you change it to 17 and 7 or something like that?
Yep.
Like, why don't we move some chips, or like 8%, move 2% from financials and re-push it and push it over to the mega tech, because that's what you feel.
Right.
It's not like I'm going to get rid of all financials because I'm just making a stand.
Yeah, exactly.
That's not what we want to do.
Yep.
So that's how I would describe number one, is like, don't overreact and start moving a large amount of chips.
Yep, for sure. If you have a strategy, stick with it. And like Tony said, it's good to tweak. I'll also mention is maybe a good time to rebalance if that isn't something that you're normally doing. If your base position is 70% stocks and 30% fixed income and others, maybe over last year, maybe you're now 75% in stocks because they grew. Beginning of the year, I'd say once a quarter is a good time to do it.
The rebalancing?
To rebalance, yeah.
And that's what I was going to go into, like mistake number 2.
Okay, look at that segue.
Yeah, because that's exactly what I had down as one of my notes for number 2, and that's chasing what worked last year. I'll tell you what, if you're going to chase what worked last year, you're too late.
Yeah.
For example, I don't think many people would have thought commodities such as gold and silver would have been up over 100% each.
Right.
the reason that it's up 100% is because no one saw it coming, to be honest, right? And then when you start seeing it go up, and I'm not going to say that it can't continue and not to have exposure, but some people are like, man, can I get 10 to 15% exposure? I'm like, no. Like, I'm not going to tell them no, but I'm going to say I think it's okay to get involved. I think, if you've seen the curve, it's parabolic.
Right.
Usually when you see a parabolic curve to the upside, it comes down pretty quick. And again, I know it's a commodity. I know it's highly sought after, and we're gonna do a show on that in the coming weeks.
Yep.
On gold and silver and commodities and things like that. But my big thing is like, and you kind of alluded to it, is like, why don't you rebalance? And here's another thing. So last year was up, close to a 20% high teen kind of year. And so were the two prior to that, 23 and 24. The difference between 23 and 24 versus 25 is that everyone participated last year. It wasn't just AI megatech stocks.
Yep.
Everything participated. The tide rose all ships, not just one or two. It everything picked up. So if you're going, and that kind of goes back to being number one, having a well-balanced portfolio going into this year is going to be phenomenal. Look what happened on Monday, this Monday, when over the weekend, Trump went in and took over Venezuela, went and got the president there. Guess what happened? Oil stocks, like every oil stock was up 5 to 15%.
Yep.
If you were like, hey, I'm involved in AI, not energy, like you missed out. Like again, it's about being balanced and having exposure to everything.
Yep. And yeah, I'll add one thing. It's and I've been having this conversation with a lot of my clients, in the fourth quarter so far this year as well. What Tony just said there, 3 years of really great market performance. Yeah. I'm not saying it's just going to come crumbling down or anything like that, but it is, it would, just that fact alone right there would lead you to probably be a little bit more cautious than super aggressive.
Right. There are a lot more tailwinds than headwinds going into 26. Don't get me wrong, but man, we are in uncharted territory. To the point where it's like 3 years that have been up over 15%. I don't think has ever happened ever. This is a 1 out of 100 type. Yep. It's a 100-year storm. And not saying that we can't grind forward, but usually in a midterm election year, I believe the average downturn in a normal year is like, like the average correction inner year is like 11 or 12%. A midterm year, it's like 16. So there is going to be a volatility. I don't know exactly what's going to cause it. I don't know exactly when it's going to happen. The first quarter should be relatively smooth, and it's when we start getting into the election time, that April and beyond is when we could start seeing some upheaval, because, you're going to start seeing branches of, the government switching possibly from red to blue or blue to red and things like that. So
Republicans really got a lot of stuff done with their majority. That's not true. It's absolutely swinging and whiffing. But I digress. But yeah, and that's actually a good point. The market usually likes when there's when the government can't get things done. When there's
gridlock.
Yeah,
when there's gridlock and you have there. I mean, there's positives to that, but there's also negatives. When it's all one color, red or blue. Yeah, you're going to get a lot of stuff done, but there's going to be half the population is going to be pissed off on the other half.
Exactly.
So, anyway, but to get back at this is, rebalance the portfolios, and it's okay to take profits. It's okay to put money into areas that may have underperformed last year, because I believe in mean reversion. I believe that things will come back. It's not like things stay out of favor forever.
Right.
Eventually there will be stocks that are in energy, for example, just hypothetically, that have underperformed the last 2 years. Well, I believe that things will catch up. They will become of value on a historic basis of where they have been and where they are today.
Yep, for sure. We were just talking about mean reversion before the show with Baker Mayfield.
Oh boy,
so that was a nice, nice transition there.
Baker Mayfield.
Still love you, Baker.
Yeah. I thought there was high hopes for that boy this year. He looked good, fun and feisty.
He got hurt again. He definitely got hurt again, and when that happens, it's just not going to go well for him.
Yeah, I agree. All right. Mistake number 3: confusing activity with progress. Doing something, feels productive, but unnecessary changes just create risks, cost, complexity, without improving any outcomes. So basically what we're trying to say there is, you don't, just because it's a new year doesn't mean you just, again, have to hit the rehaul button and just rehaul everything. Let's start with the simple rebalance, right?
Yep.
And go from there. We don't need to go in and with an axe and start chopping wood.
Yep. So. But yeah, it's, new year also off of that, is a good time to also reassess your position. So I think that's what we've been trying to say with rebalancing. That's what we've been trying to say with the returns that we've seen the last 3 years. It's a good chance to reassess your position. And when you're reassessing, right, you're gathering new information. And hopefully that information that you're gathering is telling you, hey, we need to stay the course here. We need to make a few adjustments, but our plan is good, and we're going to keep it moving forward.
Right.
Just blowing things up just for the sake of trying to get things accomplished is not what you want to do, especially in your 401k, IRAs, things like that.
Yeah. I can't reiterate. A simple rebalance is key. As it should, could be quarterly, could be annual, however you want to do that. But also, I have run into some people that were terrified of the tariffs, went to cash and stayed there, and missed out on 10, 20% gains from that bottom, if not more. So what I'm trying to talk about with there is push, if you sat on all that money, it's not like, oh, it's the new year, let's just push it all in.
Right.
Like if you're like, hey, all right, maybe I made a mistake, I want to get back involved, does not mean, hey, I'm just going to go 100% all in on the money I put on the sidelines.
Yep.
Like maybe we should dollar cost that in on a quarterly basis and see, make sure we're not going to hit a stone wall. But when we get in there, right?
Yeah, if you make those big decisions like that, it's going to take patience to undo them. So, that's really one of the main problems with trying to time the market is you have to time it correctly twice, and it's usually the second time that the second decision that gets people in trouble. So usually that's when to push things back in, and it's usually too late.
Right. I mean, the market has great momentum on melting up right now.
Yep.
But that doesn't mean, again, just to throw everything in right now. It would be a very risky move with markets at all-time highs.
Yep, for sure.
Right. But it doesn't mean that we can't go higher. But odds would tell you that there'll be some type of pullback.
Yep.
But it doesn't mean continue to wait for that pullback. Like being involved is the main part.
Yep.
Being smart on where you have that money and having some dry powder, some extra money to push in when the market does come back is a prudent idea, especially if you pulled money out of the market last year because you were worried about the tariffs.
Yep.
And were scared to get back in.
Yep, for sure.
All right, Dave, take us home, man.
All right. Well, hey, Happy New Year to everyone. Thanks for listening as always. If you guys have any questions, ideas for a show, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.